Howdy! Before we begin, please note that these dashboards were created by a programmer exploring data visualization techniques on a new platform. Some of these elements are designed not only for end users, but also to assist front-end engineers in fine-tuning or overhauling dashboards. I plan on enrolling in an in-depth course offered by the Institute of Trading and Portfolio Management at the end of this year, which I hope will deepen my understanding of the market dynamics and trading strategies. This education will enhance my ability to interpret and present financial data effectively, with these dashboards being the foundation. Utilizing data visualization tools like Qlik or setting up custom dashboards in Google Colab is a strategic approach. Qlik's associated data model and intuitive interface enables us to uncover hidden insights and make informed decisions quickly. That is only if your data is up to snuff. Similarly, Google Colab provides a flexible environment for creating interactive dashboards, which is particularly beneficial for analyzing complex trading data. These tools not only facilitate a deeper understanding of market trends, but also the creation of customizable dashboards that can adapt to evolving trading strategies. Final caveat, been burning the candle at both ends, and this blurb that I'm mentioning right now is to remind me to clear filters between dashboards. With that said, welcome to the walkthrough of the Great Financial Crisis using a series of interactive dashboards. We'll explore how various market factors and inflation trends behave during that period. This presentation isn't meant to predict the next crash or even serve as financial advice. It's a basic school project demonstrating Qlik Sense dashboards. I am a programmer by trade, taking a data visualization class, so you'll see oddities in the dashboard where it more functions as a visualization and diagnostic tool. This is on purpose because since I'm a user and I consider myself a client of this project and I like to be able to see variables in action, I like to have debugging KPIs, which I've just now learned what KPIs are, on the dashboard if needed for either improvements on the project or just to see if things are going wrong. I'm a doohickey type of guy. Okay, now onto the sources for this project. The data sources include the Fama-French three-factor model, the National Bureau of Economic Research, and Consumer Price Index, both the core and the headline, as published by the Federal Reserve Bank of St. Louis. Our first dashboard, titled the Fama-French Bull Bear Period Drill Down. So we're going to begin with market risk, focus on the market risk premium. This is the extra return investors expect from the stock market above the risk-free rate, which is typically the return on short-term treasury bills. It's a key part of the Fama-French model, which expands on traditional capital asset pricing model, or the CAPM, by adding two additional factors, value and size, to better explain variations in stock market returns. The value premium compares returns of high book-to-market stocks to low book-to-market stocks, value versus growth. The size premium reflects the performance of small cap stocks relative to large cap ones. In this dashboard, so let me go ahead and fix this. Market risk, we're going to go to 2000, 2007, 2008, 2009. Okay. In this dashboard, we will zoom into 2007 to 2009. That goes from the beginning, kind of the bull market, into the heart of the financial crisis, and then kind of recovery. In 2008, the market risk drops precipitously, showing a clear signal that investor appetite for risk was in free fall. Let's go to value premium. The value premium briefly turns positive. This suggests a temporary shift toward undervalued stocks, likely in search of perceived bargains. Now let's go to the size premium. The size premium rises during the crisis, showing that smaller companies began outperforming large ones despite overall market volatility. By 2009, you can kind of see the early signs of recovery appear by the, let's go ahead and flick on three of these. Okay, so we got one, got two, got three. You'll see the green line kind of appear towards the kind of the beginning of 2009. So for long-term investors, this dashboard helps contextualize downturns in the form of only these three factors. It being a dashboard, you have various types of input data. You could greatly expand this. I hope to, if not use this, expand upon it as I start my investing class for studying macroeconomic trends. Okay, so once again, this is not about predicting market moves. It's about understanding how different return components behave when confidence in the market erodes. The bull and the bull and bear market color overlays, as we discussed before, provide visual clarity, and the drill down controls let us move from decade to year to month level insights. And just as a reminder, here's one of those oddities. The placeholder value V factor index and the value is meant for temporary debugging, because at the beginning of this project I had kind of such a hard time ensuring that I was actually mapping the right thing. And this is the foolproof way of doing it. And that's just how I roll. All right, let's go to the second dashboard. Okay, reminder, clear your filters. Second dashboard. Second dashboard is titled Factor Correlation Explorer Trends Across Times and Regimes. Now let's explore the factor fringe models and how they relate to one another during the financial crisis. In this dashboard, we will focus on the relationship between market risk premium and value, looking at how those factors moved from 2007 to 2009. And I already had this. Let's put a 1 in there and then go ahead and hit tab. Okay, so now we have green on the lower left. I'll talk about debugging at the very end of this. Okay, so we got 2007 January 1st to 2000 and the exact end of 2009. So we're using a 3-month window correlation to track how the relationship changes over time. During the bull market phase in 2007, the correlation between, let's see here, and value, year on value. Okay, apologize for that. During the bull market phase in 2007, the correlation was somewhat even between positive and negative. And then when the bear market took over from October 2002 October 2008, the relationship turned kind of unstable. It was kind of seesaw twice as much as the previous during kind of the whole bear 3/4 of the bear market cycle. And then you see kind of a positive correlation starting at the end of towards the end of 2008, and it kind of stays positive through the end of at least our analysis period. So for quantitative researchers, for that small little data snippet, which hopefully I got somewhat right, these swings help reveal when model transition between correlated and non-correlated for various market factors. For long-term investors, a reminder that diversification doesn't always protect you the way you expect. Kind of had everything fall apart in the financial crisis of 2008. The focus, at least from like 2000 to even 2010s, was this is not, you can't invest in the market. It's flat. These are outside variables I'm using, like the S&P index, etc. Generally, long-term investing, it just cusps at 3 years, and you probably need to go to 15 years. Once you look at 15-year cycles, which is one of the sticking points I'm having for investing that I'm not currently showing on this dashboard, is that you need to wait quite some time. And you're going to see the ability to say, hey, well, how do I get to that point? You're gonna see that if you use dashboards like these to better look at correlations between various market factors. Okay, so let's see here. Okay, so I'll make one more comment about the rolling window slider. I tried to include as many factors as possible. I just went ahead and went nuts with this. So you have 3 months, 6 month, 1 year, etc. Oh, oops, that's not a period of 15 years of what we were looking at, but it's as many windows as possible, because sometimes people like to look at 100-year cycles, which the data varies from like 1926 to 2020, and some of them go from like 1926 to or 1957 to like 2025, etc. So that's why it's good to have these rolling windows on here. Okay, so for the third dashboard, let's see if I have everything. We're going to do, okay, so we'll do that, 2007 to that, check. Okay, so we're going to go to AUSL first. Okay, so the third dashboard is titled CPI versus FAMA French Trends. Now it's at an economic layer using Consumer Price Index data, or CPI. The CPI tracks how prices change for everyday things like food, rent, gas, and healthcare. We have 2 CPI measures mapped in this dashboard. Headline CPI, the CPI AUCSL, measures the overall change in consumer prices, including food and energy, reflecting inflation experienced by most urban consumers. Then we have the core CPI, CPIL, FESL, excludes food and energy prices for a more stable view of long-term inflation trends. Looking, looking from 2007 to 2009, both CPI series indicate inflation stayed relatively neutral, mostly between 1% and 3%. Let's go ahead and toggle between the 2 CPIs. And so let me go look up, okay, so we got headline. Okay, so we're going to go back to headline, and then we're going to go to this, pretty much neutral through 1% through 3%. This dashboard overlays CPI with the market risk premium, so we can observe how inflation and returns behave together. And we can also look at the size premium over time, and then we can also look at the value premium over time. So this is helpful for instructors who want to show students how various market factors, inflation, economic cycles correlate over specific periods of time. Because we got market factors, CPI, and then we have the bull bear color legend scheme. It's also useful for policy researchers who can study how market behavior changes, market behavior shifts between low and neutral and high inflation regimes. My bad. Okay, so I do have a minute before the conclusion to at least briefly talk about the way I operate. So I am going to go ahead and just display this real quick. I like knowing when things are wrong. So I'm going to go ahead and put in a wrong date. Dates outside time range and the start date must be in a correct format. I have error handling on here, so I know to say, hey, let's go to 1900, 0101. Let's see if this works. Okay, so the dates are outside the range. And the range is only from 1926 until like the late 2020. So let's go ahead and do 2025, 0101, because I think it was actually 2020. Okay, and I'm pretty much right. So the date range itself is valid, but the dates are outside the data range. I like doing this because you're building up data sets where you have so many things going on. It might not look that organized now, but as I get more proficient, I'm going to figure out better ways to do this, and I'll have people throwing bananas at me or cabbage saying, hey, dude, this is not working for you. So the way I have this is start date, end date. You have to say, okay, dates outside data range. On the top, I assume that it's the market factors. I could probably label it better. And then at the bottom, I just outright state it, CPIL, FESL, and because it was too large for the specific thing, and I like using variables. If some other user wants me to change it, I'll change it. So CPI, FESL is out of range, and then I think the same thing with here. One of these was, let's do 1927, 0101, and, oh, whoops, wrong one. All right, so we're gonna do this, and then we're gonna go ahead and 2020, 0101. I know one of these was, excuse me. I think both of these, so 1927-01, oh, because it was July. 1927-07-01. Let's see here. How embarrassed am I going to be? So 1927, we're just going to go to 1928. 1928-01, 01. Date range is valid, CPIL, SL. That is very interesting. I guess this is going to be a gaffe. Oh, 1957. Let's do 1958. 0101. All right, come on. Okay, there we go. Okay, so I think the CP FESL was 1957, and then the AUSL was probably, let's do the 1930, 0101. It might have been like early 2026. Let's see here. Yeah, you can tell I have one thing of improvement for this 1957, 0101. There we go. Okay. I think I have a variable tied up that I can improve between the error handling here. But the overall goal was to say, hey, this specific variable was, oh, that's a gaffe. Let's see here, 1947-01-01. Okay, so I know I have about a minute and a half. Sorry for the gaffe. But I completely forgot. Bottom, middle, start date of the CPI AUSL was 1947, January 1st to 2025, 0201. And then I have it where the CPIL, FESL, 1957, January through 2025, February 01. So apologize for the gaffe. This is the reason why I have this stuff on there. I get flustered when I talk, and sometimes people forget stuff. And I also have the data floor, data ceiling. I like seeing variables in play. I'm gonna go ahead and stop there for the presentation, and now for the conclusion. All right, so bringing it all together, what did we learn? Market risk premium dropped sharply in 2008. Factor relationships broke down under stress. When the market stabilizes, we are seeing certain market factors correlate more strongly. Inflation overall remained neutral. These dashboards don't help you time the market. Again, I gotta say that. They help you understand how market factors behave under pressure. So we got market factors, inflation, and other economic cycle data, and help you build realistic expectations as a long-term investor in planning out your portfolio. Whether you're managing money, modeling strategies, teaching, or shaping policy, this approach gives you several tools to analyze specific measurements against different market conditions and how each economic cycle affects those aforementioned market factors and measurements. Again, sorry for the couple gaffes. Thank you for your time, and that concludes my presentation.